The proven wealth strategy that outperforms the market. Want to build lasting wealth and outperform the market? Rocket the best investors follow a proven strategy, and today, I'm breaking it down step by step. Stay tuned because these principles can change the way you invest forever. Before we dive in, hit that like button and subscribe so you never miss out on game-changing investment insights. Most investors elude the goal of consistently beating the market. However, certain investment philosophies have demonstrated the ability to outperform over time. This guide outlines a proven wealth strategy that leverages value investing, compounding, risk management, and behavioral discipline to achieve superior returns. 1. The power of long-term thinking. The myth of short-term trading. Many investors attempt to time the market, but studies show that short-term trading leads to higher costs, lower returns, and more significant emotional stress. Long-term investing benefits from compounding and reduces the impact of volatility. The Buffett approach. Time over timing. Warren Buffett's success underscores the importance of long-term ownership of high-quality businesses. Buffett has achieved extraordinary returns over decades by focusing on companies with durable competitive advantages. 2. Value investing. Buying dollars for 50 cents. The core principle of value investing. Value investing involves identifying stocks that are undervalued relative to their intrinsic worth. Legendary investors like Benjamin Graham and Warren Buffett have demonstrated that buying high-quality businesses at a discount leads to superior returns. How to identify undervalued stocks. Price to earnings (P/E) ratio. A low P/E ratio relative to industry peers may signal an undervalued stock. Price to book (P/B) ratio compares a company's market value to its book value. Discounted cash flow (DCF) analysis estimates a stock's intrinsic value based on future cash flows. Economic moats. Companies with strong competitive advantages tend to sustain higher profits over time. 3. The role of compound interest in wealth creation. The magic of compounding. Compounding occurs when investment gains generate additional returns over time. This exponential growth effect is the reason long-term investing is so powerful. Case study. How $10,000 becomes $1 million assuming an annual return of 10%, historical average for the S&P 500. An initial investment of $10,000 grows to over $1 million in 50 years. The key is patience and reinvestment. 4. Risk management. Protecting capital. The importance of downside protection. Avoiding significant losses is just as important as earning high returns. Risk management strategies ensure that investors can stay in the market and benefit from long-term growth. Key risk mitigation strategies. Diversification. Spreading investments across asset classes reduces risk. The margin of safety. Buying assets below intrinsic value minimizes downside potential. Avoiding overleverage. Excessive debt magnifies losses during downturns. 5. Behavioral discipline. Mastering the psychology of investing. Common investor pitfalls. Emotional trading. Fear and greed lead to poor decision-making. Chasing trends. Buying into hype often results in losses. Overconfidence bias. Many investors overestimate their ability to beat the market. How to develop discipline and stick to a strategy. Avoid reacting to short-term market fluctuations. Automate investments. Regular contributions reduce emotional decision-making. Adopt a contrarian mindset. Buying when others are fearful often leads to great opportunities. 6. Dividend growth investing. The power of passive income. Why dividends matter. Dividend-paying stocks provide a steady income stream and enhance total returns. Reinvesting dividends accelerates compounding. Characteristics of great dividend stocks. Consistent dividend growth. Companies that increase payouts over time. Strong cash flow. Ensures dividends are sustainable. Reasonable payout ratio. Avoids excessive distributions that hinder growth. 7. The role of index investing for consistent returns. Why passive investing works. Most actively managed funds fail to beat the market over time. Low-cost index funds, such as those tracking the S&P 500, provide broad diversification and strong long-term performance. Combining active and passive strategies while stock picking can lead to higher returns. A mix of active and passive investing balances risk and reward. 8. Tactical asset allocation. Adjusting for market conditions. Understanding market cycles. Economic conditions impact different asset classes in varying ways. Adjusting allocations based on valuations and trends can enhance returns. Strategic rebalancing. Periodically rebalancing portfolios ensures alignment with long-term goals and prevents excessive exposure to overvalued assets. 9. Case studies of successful investors. Warren Buffett. The ultimate long-term investor. Buffett's strategy of buying high-quality businesses at fair prices and holding them indefinitely has resulted in extraordinary wealth creation. Ray Dalio. The importance of risk parity. Dalio's risk parity strategy emphasizes diversification across asset classes to manage volatility and enhance returns. A blueprint for beating the market. The key takeaways: think long-term. Time in the market beats timing the market. Invest in value. Focus on fundamentally strong, undervalued companies. Leverage compounding. Reinvest earnings to maximize growth. Manage risk. Protect capital through diversification and disciplined investing. Stay disciplined. Avoid emotional decision-making and stick to proven strategies. By following these principles, investors can build lasting wealth and consistently outperform the market. That's it for today. If you found this strategy valuable, don't just watch, take action. Start applying these principles and let time work in your favor. Start now. Stay patient. Build wealth. Got questions? Drop them in the comments, and I'll be sure to respond. And hey, if you enjoyed this, make sure to subscribe and turn on notifications so you never miss an update. We're sending you more powerful investing tips.